housing market has risen in value pretty much anywhere you live in this country. And while that's not great if you're trying to buy your first home, it can be great if you've owned your home for a while and built up some significant home equity. Now, the challenge is, how do you extract some of that? How do you use some of that? People are quite well aware of reverse mortgages, home equity loans, home equity lines of credit, all that. But there's a new entrant in this broad conversation. It's been around in the US for a couple of decades, but new here. It is called a home equity sharing agreement, or an HESA. And we're going to talk about what it is and how it works. Our guest is Shael Weinreb. He is CEO of the Home Equity Partners. They offer this model in Southern Ontario, and he joins us now to talk about how it works. Hello there.
Hi, Bruce. Thank you so much for having me today.
A lot of people feel like their home equity is trapped. So they've got this house, maybe they've even paid it off in full. How does the HESA or HESA or however you call it, how does it work to solve that?
Yeah, so the HESA is really designed to help people that are really being underserved by the Canadian financial system. Um, and I sort of just draw on sort of personal experience for a second. My father, as a matter of fact, was one of those individuals that had built up a substantial amount of equity over sort of his lifetime in his home because of rising real estate prices, had been responsible at paying down his mortgage. And then when it came time in his early 80s to draw down on some of that equity because of some unexpected life, expenses and unfortunately some circumstances that happened to our family, he was ultimately shut out by the bank, a bank that he had been a client at for about 40 years.
Hmm.
And it put a lot of strain on our family. And what I learned through that experience is that the bank kind of looks through an applicant for an equity line of credit or a HELOC with a very narrow lens and with a very specific set of criteria. And if you don't sort of fit nicely into that box, it becomes incredibly challenging to qualify for any sort of extension of line of credit to be able to access that equity. So we decided to take a product that takes a much more holistic and entrepreneurial approach to a homeowner that is looking to access some of that equity.
So give us the basics here of how a HESA works.
So a HESA works in the sense that we at the Home Equity Partners will invest anywhere between 5 to 17.5% of the value of your property. So in other words, Bruce, if your house was worth $1 million, we at the Home Equity Partners would invest a check or cut you a check for anywhere between $50,000 or 5% of the value of your property, all the way up to 17.5% or $175,000. So those are sort of the goalposts that we work with. And then based on sort of the amount that you need and based on the amount that we feel comfortable extending to you, we'll arrive at an amount. And effectively, let's say, Bruce, you need $100,000 and we feel that's an appropriate amount. We'll cut you a check for 100 grand or 10% of the value of your house. And you'll have that $100,000 for a term of 10 years. You can exit at any time. There's no sort of requirement to stay with us for the full 10 years, but you have the benefit of a 10-year term with absolutely no monthly interest payments and no interest payments or no monthly payments. It's payment free for the next 10 years.
And then you make your money by?
And we make our money by bringing in money from investors who want access to the residential market, and they pay us an asset management fee to be able to go out and find the types of deals that they're looking for in select neighborhoods across the GTA. So they pay us a fee to originate those deals for them.
Yes. And then their return, is it predicated on the appreciation in that home and then the sale of that home?
Correct. So it's very much, it's not a loan, it's an investment. So to your point, if the house goes up in value during the term of the relationship, then the investor will participate in some of that upside. And depending on the amount and the percentage amount that they invest in your home, that will very much dictate the amount of upside that they would be entitled to, and obviously the remainder that you as the homeowner would keep. Conversely, if your house actually went down during the term of the relationship, then they would participate in the downside with you as well.
I know this is like comparing apples to chocolate cake, but what is a simpler explanation is how a reverse mortgage works. So it's similar in some ways in that you get an amount of money, you don't have to pay a monthly payment. But in that world, the paradigm is a rate, and the rate of interest is higher than it would be if it was a 5-year fixed rate mortgage, but you can kind of wrap your mind about how that works. If you
Right.
were then to compare this model, what does the total cost look like, knowing that every single house is going to be valued at a different level and it's going to sell for a different level? So I know apple, chocolate cake, but how would you think about the dollars associated with those two options?
So reverse mortgage versus our product, the HESA or the home
Yeah.
equity sharing agreement.
Yeah.
Um, it really depends. I mean, at the end of the day, the only exposure that you have to us is really the upside or the appreciation that you experience on your home moving forward. So if your house goes up 3% per year over the course of the 10 years, then that's going to sort of create, I guess, an ultimate number. And then we would share in part of that. So it's hard to say. I mean, we have a sort of a base case appreciation number in our mind. And that could ultimately sort of determine what you would otherwise owe us. Versus, to your point about a reverse mortgage, it's very much a prescribed rate, and ultimately what you're going to be sort of accountable for, I guess, at the end of the loan.
Right.
Um,
The word equity implies ownership. Do you actually have a stake in the home? Do you own that piece of it?
We don't. So no title transfer takes place. We don't come on title as a co-owner of the property. Ultimately, as the homeowner, what you would enter into with us is called this home equity sharing agreement, was a contractual agreement. And then on top of that, we will register a mortgage against the property to protect our investment. But from an ownership standpoint, nothing changes. You are still very much in control and have full ownership of your home.
I referenced that this has been around in the US for a while. What have they learned, and therefore have you learned, about the clients that this is the best fit for?
We're really seeing, based on our research that we've seen over the last number of months, it's really sort of a full spectrum. It seems to apply more probably to people 60 and over, um, whether it's because that they're sort of in a better position to have acquired or sort of built up a sufficient amount of equity to qualify for the product, where they have loved ones, call it the next generation, that they want to help, either kids or grandchildren. Um, or because people are living longer now and they're sort of in that retirement stage, so income obviously isn't what it used to be. They're looking at this as call it a more accessible way to access some of the equity in their house versus maybe somebody that's still in the workforce and that still may have, I don't want to say a substantial income, but an income that the bank thinks is appropriate to extend a
Hmm.
line of credit. So that seems to be probably more of the demographic in the US, I would say, is 60 and older.
We've come a long way in the conversation about reverse mortgages, even over the last 5 years or so, where there's an acknowledgement that there's a particular client that it can work for, but it's not for everybody. There's more transparency around the fees associated with that and the risk of masking a cash flow issue that really needs to be addressed at its root cause. And that could mean selling the house. What are some of the risks or pitfalls that people should know about when it comes to the HESA?
That's a good question. I think the major consideration that anybody should sort of really keep in mind when looking at our product are a couple things. One, this is really designed to be sort of a longer term product. If this is something that you want to sort of get in and out of over a year or two, it could get somewhat expensive, based on some of the fees, based on a couple of the other items that we sort of include in our package. If this is something that you're looking to do beyond 3 years, it starts to make a lot more sense. And then really number two ultimately is really based on how the real estate market trends. If the real estate market in the GTA, as an example, continues to do what it's done over the last number of years, then there's really no cap, I suppose, on the exposure that you could have to us, sort of moving forward. But what we do with the home equity partners is we're hyper transparent. So to mitigate that risk for you moving forward, to always keep you in the loop in terms of kind of where your house stands market value wise, is that we will give you an assessed value every single year so that you understand where your property stands as far as, call it, the fair market value, and what in that particular year your exposure would be to us, so that there's no surprises.
Mm.
So at the end of the 10 years, the goal is not to send you and say, oh, by the way, your house has gone from $1 million to X number, and all of a sudden you owe us X, and you had no way of telling what that ultimate number would be. We are definitely going to be communicating with you
Mm.
the entire way so that you feel comfortable at all times.
The landfill is chock-a-block with companies that have tried to disrupt the real estate market for decades. We've been talking about all sorts of ideas in as it relates to agents and funding and all those sorts of things.
Right.
What are the risks for you as a company? Because I can imagine a major downturn in the housing market could make your financials just not work anymore.
Right.
Did I just
Um,
give you nightmares? You're now not going to be able
a
to
little
sleep
bit,
for days.
a little
Surely
bit, a
you've run
little
some sensitivity
bit.
testing, right?
That's right. That's right. I mean, listen, it's a fair point, and obviously, if there's a housing market crash, that's not great for us or our investor group. But it's our responsibility at the Home Equity Partners to be able to be on top of that and to mitigate risk, I guess, moving forward, in the sense that we're going to sort of participate in markets that we have a lot of conviction in. We think that the Greater Toronto Area is a great place to invest for our investors. We think it's a wonderful city. I was born and raised in Toronto, and we have no reason to believe at this point, especially with interest rates going the way that they're going, which we hope is sort of declining over the next number of months, as it maybe has already, that we don't see any sort of near-term major headwinds. But we'll always sort of keep our eye out for that, and sort of steer the ship accordingly.
I have no view as to the suitability of this product for people or whether it's going to take off. But what I do find inspiring is it's a different way to think about something, a different way to think about a problem
Thank
that
you.
I'd never heard of before. So thank you for joining us to talk about it.
Thank you so much, and really appreciate you having on the show. And you're doing great work as well.
Thank you. Shael Weinreb is the CEO of Home Equity Partners. He was here to talk about something called the HESA. That is the acronym for the Home Equity Sharing Agreement.